Good morning and welcome to Managerial Accounting. As always, we'll start with a look at our calendar. We talked quite a bit last week about the option of doing a draft of your annual report project. Remember, if you want to do that, it does need to be a completed, what you believe to be a completed draft of the project. So please do not submit something that you know is half done, because that is a waste of my time and yours. Just one moment here. Okay. Everybody's getting a late start today. My sister went to visit her daughter in Alabama over the weekend, and she sent me pictures. Just got back yesterday, sent me pictures of the flowers that are, blooming in Alabama, because it's actually spring. And then I look out our window and everything is completely covered in white. So I'm holding out hope for Thursday. It's going to be a little nicer. So let's take a look, as I said, at our calendar. We have the draft due today. It's an option. Please do not submit if you do not have a completed version of the project, because I grade it as if it's a completed version of the project. So if you do not have it in today, as I said, I won't guarantee that I can look at it to get feedback to you in time to get any updates made before the project is actually due next week. Any questions about that, about the project or anything else? So we finished chapter 23 last class, so the chapter 23 problem is due by the end of the day today. And we're going to be starting chapter 24 today on evaluating decentralized operations. And so you should be submitting for grading the chapter 24 pre-quiz by the end of the day today as well, to be on track with those due dates. As you can see, I put up the April calendar so you can be reminded of where we're going. We'll be covering chapter 24 this week, chapter 25 next week, and then JCC is on break this week leading up to Easter. So on the 7th, next Thursday, we'll finish chapter 25, which is the last chapter on the third exam, but because of the break, then the chapter 25 problem isn't due until the Tuesday we get back. And so the exam isn't scheduled until after that problem is due. So our third exam is scheduled to be due on April 24th. The reason I'm mentioning this today is, for some of you, it may be that this week off is a time for you to work on that exam. And so you should feel free to take the exam whenever you are ready after completing chapter 25, including the problem. So even though it's not due till the 24th, it is open, and you're welcome to take it over that break if that's what works for you. Some of you, I'm sure, will have children home during that break, and taking the exam while you have children at home is probably not the best plan. But I just wanted to make sure you're aware that that is coming up. We will have completed all of the coverage of the content for the 4 chapters on that exam, and you're welcome to take it and get it out of the way if that works best for you. So that's where we stand. When we come back after break, we have 3 weeks of class left. We'll cover, as we have been, we'll cover 1 chapter a week. Now you will notice, just like with chapter 23, some of these chapters are a little bit shorter and will not necessarily take us the 2 full class days to cover them. And so as we look at each chapter, I'll kind of be gauging whether we want to still cover half each class, or and maybe get out a little early both days, or whether I'll be asking your opinion. Do you want to just keep moving on and then have a super short day possibly on the second day for the chapter? So you can be thinking about that in general, whether you'd rather have 2 short classes in a week or 1 regular length class and 1 extra short class, because it makes no difference to me. I will be here and be working either way. So any questions about what's coming up? This is really long range looking, but just as we look ahead, the last official day of class here is May 10th. However, that would not generally be a class day. That's listed, I think, as optional review on your syllabus. We will have completed our final chapter. We'll have finished the entire book, all 28 chapters, on Thursday, May 5th, and Cinco de Mayo. And so this final class day is not an actual class. I will be here. If people need to review or ask questions or work on the problem or anything like that, we can use that class for that. But otherwise, there won't be a formal class on that day. And then that fourth exam covering just chapters 26, 27, 28, the chapters that we cover after the break, will be due on Friday the 13th, my daughter's favorite day. And then final grades are due on the 16th. A little bit off topic, not having to do with accounting, but having to do with JCC. Most of you are in the business and entrepreneurship career community, and so you should have seen an email come out from me as the lead for that career community yesterday about registration. So if you plan to come back, if you plan to take courses in the summer and or the fall, if you're graduating, congratulations, good job, and good luck with the future. But if you do plan to come back to JCC, even if you are graduating, we have a lot of students who do that, graduate in one degree and decide to work on something else after that. So if you do plan to return, summer registration is already open, but in practice, most people just register for summer at the same time they register for fall. If you are a military veteran or are in the JCC Honors Program, advisement will start for you on April 4th, Monday. And then, of course, we have that week off for the spring recess. And then for everyone else, registration starts on April 18th. So if you do plan to take summer and or fall classes, you should be looking to make an appointment with your advisor. If you don't know who your advisor is, you should be able to see that in your Success Network in Starfish. If you don't see anything there, it is possible, although not likely, that you don't have an advisor assigned to you, and you can just reach out to me. I can either assist you or I can point you in the right direction, especially if you are not a business major. So please let me know how I can help with that process. And that's my public service announcement for today. Before we get started on the new chapter, chapter 24, does anyone have any questions from chapter 23? Okay, I just need to close the door. It sounds like somebody's running a vacuum or something. All right. Should be a little quieter. I don't know if you guys on Zoom can hear that, but in the classroom, it feels like it's very loud. So let's go to our new chapter. Chapter 24 is on evaluating decentralized operations, and some of what we'll see in these learning objectives, starting on the next page here, and they're going on to the next page as well. So some of these will sound a little bit familiar to you. I know I have mentioned responsibility accounting specifically in one of the recent chapters, and I had suggested that we would be coming back to that concept of responsibility accounting, which is really the idea of holding managers responsible and evaluating their performance based only on those costs that come under and revenues that come under their direct control. So we talked about this as we were discussing the allocation of support departments and in suggesting that, we really shouldn't be holding management accountable for allocated costs that are not within their control. And so as we go through this chapter, we'll be talking about, so how do we evaluate these various responsibility centers based on what it is the management can control within those centers. So you can see 3 different versions of responsibility centers listed in these learning objectives here. We have a cost center, a profit center, and then an investment center. And as we work through this chapter, you'll see that as we evaluate management's performance, in each one of those 3 responsibility centers, we will be using different techniques, different tools, different calculations. So that we are really only looking at the part of the financial statements that comes under their direct control. At the end of the chapter, so on Thursday of this week, we will be looking at these final learning objectives about transfer pricing when we have various segments of our large operation. When we look at the big company, maybe there are 3 different divisions, and the 3 different divisions might trade or buy and sell to and from each other. And so how do we price that product is a real question for our organization. And so we'll be looking at a few different ways of considering how to price those products. Any questions before we really get started with our new material? Here's the overview of what we're going to do. As I said before class started, we will get to the exercises very shortly here. So please, if you haven't already, open your chapter 24 exercises in See Now. And so as we look at this diagram on our next slide, what we are really focused on here is those decentralized organizations and so we're talking about large companies. So our focus in financial accounting was always on the publicly traded companies. And so we're usually looking at very large companies. For much of what we've done this semester so far, though, the principles that we were learning could be applied to a company of any size. In fact, in many chapters, we even talked about how it could be applied in a small service organization. For those small operations or centralized operations, as you see on the left-hand side of this slide, we have one management team, and that management team is making all the decisions for that organization. And so when we evaluate management, it's a pretty simple process because we're looking at the organization as a whole. And again, usually those are very small or much smaller operations where we don't have that diffused power, for lack of a better way of saying it. Decision-making rests all on that one group, and so we evaluate that one group using the entire set of financial statements for the organization. But when you think about some of the companies that you chose for your project, and many, probably most of you, when you look at, trying to find an open spot where it's not going to be misleading. Put it down here in the bottom left corner. Most of you, when you look at the financial statements for the company you chose for your project, most of them will include this word consolidated in the title of the financial statements, the consolidated statement of operations, a consolidated balance sheets or statement of financial position. That consolidated tells you that there is more than one company that comes under one parent company umbrella. The rule is if a company owns more than 50% of the stock, so 50% of the shares, common stock outstanding, plus 1 share, You then have a controlling interest in that company. You own, you may own only 51% of the company, but you completely control the decision-making, because with your 51% of the shares, you can completely control who's on that board of directors. And the board of directors, as we talked about in chapter 12 back in financial accounting, the board of directors is responsible for setting the policy for that company, just major decision-making, direction setting, hiring the top officials of the company, and so on. And so when we think about a company that's consolidated, as most of your companies are, you're talking about a company that has lots of moving parts to it, that has more than one company under that same umbrella. And each of those separate operating units probably has its own management team that is allowed or permitted or required to make some major decisions for the company. And so as we talk about responsibility accounting, we're really looking at these smaller pieces within that decentralized organization where some of the decision making has been delegated to those local managers. I'll give you a local example. As you heard me talk about last week and maybe even the week before, on Friday we had our external team virtual visit on Zoom for the business program reviews. And one of the people who was on that team is the human resource director for Jamestown Engine Plant, Cummins Engine in Jamestown. And I learned something that day I did not know before. Cummins is the single largest private employer in Chautauqua County. They employ about 1,500 hourly people. 1,100 hourly people, 1,500 total, including the salaried people, plus at any given time another 100 to 300 temporary workers. So we're talking close to 2,000 employees at Jamestown Engine Plant, but it's just one part of Cummins Engine. And so, because they have other facilities. And so the management team in Jamestown at Jamestown Engine Plant have some authority to make decisions about their company. They don't control everything about their company. The parent, the corporate executives can still make, or are still going to be making some of those decisions. But the local management in Jamestown is also making some localized decisions, certainly, maybe all of the local decisions. And so as their performance is evaluated, we need to keep in mind what it is they do control, what decisions they are empowered to make, and what decisions are out of their hands. And decisions that are out of their hands should not be, for lack of a better phrasing, held against them if things don't go well, because they didn't get to make that decision. You follow where I'm going with this? Okay, so what we've been doing and what you are doing for your project is looking at the company as a whole. But as we're evaluating individual performance, we need to keep this concept of responsibility accounting in mind. Okay, so when we're talking about large companies, I'm going to go through this PowerPoint pretty quickly. When we're talking about those large companies, it is important to spin off or delegate some of that authority, because we can't always wait for the home office, so to speak, to make those day-to-day decisions for us. Some of the disadvantages of decentralizations, we know advantages are they're empowered to make decisions that affect their local operation out of that, in that very large company. Disadvantages are that we may not be keeping in mind how decisions we make locally impact other parts of the same company. I think that happens myself. I think that happens even within one local organization, that sometimes we forget that we're all on the same team, we're all working for that same company. It's really easy to forget when your decisions that are made locally may impact another branch of the company that may be halfway around the world. It also may lead to some duplication of effort. And so we may have multiple human resource departments, multiple accounting departments, all doing the same thing for different locations. We may have, even in terms of equipment, facilities, does it make sense to have a duplication of facilities here at Siemens and Olean and about an hour and a half down the road in Paint and Post having a similar facility? Is that duplication that is inefficient? Clearly, there are advantages to decentralized operations, or they would not continue to exist. But we need to keep in mind, how do we offset those disadvantages as much as possible? And so when we get to our work about transfer pricing, toward the end of the chapter, it was Learning Objective 5, then we'll talk more about this. We are working together or trading, selling, buying and selling with other divisions in the company. How do we most fairly set that price so that we're keeping in mind the best situation for both parts of that same company? I already pointed out in the learning objectives 2, 3, and 4 were each for different types of responsibility centers. You can see the final bullet points on this slide list those 3 responsibility centers. And we're going to be looking at in our first exercises, and it might take us, it might be all we do today, is look at how do we evaluate performance for each one of these 3 different types of responsibility centers, and they are in increasing order of responsibility. So we start with a cost center, and that's going to be the point of our very first exercise today, is doing a performance report for a cost center. A cost center has responsibility over costs, but not revenues. So this might be a manufacturing facility that's just making the product. They're not responsible for the sales part of it. It could be a typical example that we use is a factory that, or not a factory is probably not the right word, a manufacturing facility that makes the food that supplies a chain of restaurants. So the sales happen in the local restaurants, but when we look at the manufacturing facility, they're only responsible for the costs of making that food and controlling those costs. Okay. Cost centers may exist within other cost centers. And so we can go, if we're looking at that manufacturing facility making food to supply a chain of restaurants, there might be separate departments, one that's responsible for making the desserts and another one that's responsible for making the perishable side dishes. I don't know. But as we drill down into that organization, as we get to lower and lower levels, we're talking about evaluating managers that have lower and lower levels of responsibility. And we need to have a way of analyzing the performance of managers at all of those various levels. And here's a good example. So we have a university that includes 3 separate colleges. Within each college, there are different departments, and we can analyze at each one of those levels. And presumably at each one of those levels, we have a decreasing level of authority, of decision-making power. And so we're going to be looking at only for the Department of Accounting, we might only be looking at the costs. So we might say the Department of Accounting is not responsible for setting tuition and fees, and so therefore we should not be holding them accountable for any revenue generation. Our first exercise, as I said, is going to be a performance report relating to the budget for the costs that come under the control of that cost center. This is a tiny little visual. I don't know how well you can see this. It is in your textbook if you wanted to see it in a larger. But what you'll notice is as we look at the big picture, we have a budget performance report for the vice president of production. And then under that vice president, there comes the manager of plant A. And so we'll analyze that manager's performance. And then at the bottom, we have a supervisor for department 1 in plant A, and we're analyzing that performance as well. And so we're drilling down through the layers of management and looking only at the, in this case, costs that come under their direct control. All of these are examples of cost reports, budget performance reports for cost centers. You don't see revenues in any of these. And so even within that cost center of production, we can still drill down and get to the lower levels of analysis. And that's what we're going to be doing in our first exercise. So let's go to that now. And you'll see something that you can actually, big enough hopefully to actually see. These are partially completed budget performance reports for Delmar Company, which is a manufacturer of light duty motors. Each one of these separate budgets and budget compared to actual performance report gets to a lower and lower level. And so we're going to start by looking at this budget performance report for the supervisor of chip fabrication. So you can see that that supervisor is held responsible for wages, materials, power and light, and maintenance costs. And we do an in-depth analysis of the actual costs for those detail lines compared to the budget. And some of them are over and some of them are under budget. So you can see on net, the chip fabrication came in $300,000 over budget. What's not addressed here is whether these are flexible budget quantities or are a static budget. My expectation, even though it doesn't say that, is that these are based on flexible budgets. And we've talked about in the last 2 chapters why using a flexible budget is important to get an actual analysis of how is this company doing, because we know that our variable costs are going to change as our level of production changes. And so we should be using these budget quantities right here in the second column should be flexible budget quantities. And so we're looking at that supervisor, we're looking at all of the detailed lines. But then when we go up to that position's supervisor, we have the manager of the Western Region plant. That plant has 3 separate departments. Chip fabrication is just one of them. When we do an analysis for the manager of that Western region, we don't go back to the detail lines of the chip fabrication unit, because this manager is responsible for oversight of the whole operation. And so our first answers for this exercise are going to be the totals from chip fabrication, the actual, which we have right here, the actual dollars that were spent in chip fabrication, $4,300,000. Letter B asks us for the total budget for chip fabrication. Oops, here. And letter C is the net that they are over budget. And so 3 of their lines were over budget, 1 was under budget. We saw this in our variance analysis reports we were looking at last week. And so because we have 325 over, but 25 under budget, the net of that is a $300,000 over budget. And then to do our next three items, these are simply going to be totals. As we're looking at the manager of the Western Region plant, the totals of the three departments that come under that manager's direct control. So we're simply going to be totaling the actuals, the budgets, and then the over budget amount. So go ahead and do that. So did everyone get those three totals? If you didn't, say so, because I could have made a mistake with my calculator. So now we've done the analysis of the costs that come under the manager of the Western Region plant's direct control. Again, these are cost centers, so we're only talking about expenses, not revenues. And then we roll that piece up to the budget performance report for the vice president of production, who has responsibility maybe for the entire country, Eastern, Central, and Western regions. And so we're now going to be rolling the totals from the Western region up to the Vice President of Production's report. So G is going to be the same as D, H will be the same as E. And then for letter I, again, we need to net together these two quantities. So the amount that you had for F, which was a total over budget, minus the final assembly, which was under budget, to get the net amount that they were over budget in the Western region. And then to finish up part A, we are going to total the three actuals for the regions, the three budgets, and then net. Actually, it's the only one, the only region that's over budget. So we're going to just bring down letter I to letter L. It's the 375 that was letter F minus the 60,000. So it's F minus 60,000, which is 315. And then we're going to add together the three numbers in the budget column. Yeah, I have a mistake in that one. Better? And then everybody okay with those three amounts? And so as we're looking at the vice president of production, the over budget amount is 315,000. The under budget amount from the other two regions, so the Western region is the largest region in terms of cost, and it's the only one that's over budget. So the other two regions are both under budget, but not by enough to counterbalance the over budget amount from the Western region. So for each one of these levels of responsibility, again, we're looking at it at the aggregate level for this vice president of production. So we're not looking at the detail of the Western region because his responsibility is for the whole Western region, where he's not, hopefully, not micromanaging what the manager of the Western region plant does. The Western region plant manager is looking at these three departments, but not, ideally not micromanaging these individual cost categories within the department. So any question about those numbers in Part A, where those numbers come from? Okay, let's take a look at Part B then and fill in the blanks for this memo. Memo to Randy Wilkes, the Vice President of Production. The Western Region plant has experienced a budget overrun of about $300,000. Its budget reveals that the blank department caused the majority of the budget overrun. So that's the $300,000 from the chip fabrication department that caused the majority of the budget overrun. The supervisor of the chip fabrication department should investigate the reasons for the budget overruns. And where's the biggest budget overrun within that department? Factory wages by $250,000. There are also overruns, but much smaller, in power and light and maintenance. Oops. Power and light. Factory wages, power and light, and maintenance. That's the one I wanted. Again, if we're delegating that authority and responsibility, we want to make sure that we give our managers the tools that they need to manage that. We need to give them the authority to look into, why is this so much over budget? What do we do about it? And so that's the evaluation of the cost center. Any questions about that exercise or what we've talked about so far? Okay. Let's keep going then. So what we're doing in this next exercise is not really anything new based on what we have talked about even within the last several chapters about support department allocations. And so in the last few chapters, we talked about different methods of allocating support department costs, the direct method, the step down method or sequential method, and then the reciprocal method, which was the extra credit for the last exam. We know that for each of those support departments, then we were choosing an appropriate cost driver. Now, with what we've done in class, of course, those cost drivers have been assigned to us. We've been told they choose to use X, and they choose to use machine hours. They choose to use number of trees it was in one of our exercises. Our job in this exercise is to actually choose the cost driver ourselves. So we have a list of 8 support departments, and we have 8 cost drivers to choose from. And it doesn't say whether we can reuse them. My gut instinct is that we should assign 1 to 1. And our answer is simply going to be the number 1 through 8. So I think it'll be easier if we just start with letter A, accounts receivable, and look at those cost drivers, number 1 through 8. Which do you think would be an appropriate cost driver for assigning costs to account or from accounts receivable? Remember, what is the accounts receivable? Excuse me. What does the accounts receivable department do? They're in charge of collecting from our customers, right? So which of those do you think would be an appropriate way of measuring the activity of the department that's responsible for collecting from our customers? Get my chat open here. And the suggestion is 6. I think that's a good suggestion. Accounts receivable deals with collecting from our customers, so a driver of their costs would be the number of sales invoices. And so a sales department that had more invoices, but maybe they're lower dollar amounts, should actually get more cost. We wouldn't want to use total sales dollars because some departments might sell, think about trying to come up with an example. Think of a car dealership. So the dealership, if you're selling a car that costs $20,000 and it's on one invoice versus the service department that might have $5,000 in revenue, but it's 15 separate customers, 15 separate invoices to deal with through accounts receivable. So the number of sales invoices, not the total dollar amount, would make sense to be the cost driver for accounts receivable. How about central purchasing? So we're looking for something that has to do with how much work is involved in the job that central purchasing does. And it seems to me that that would be the number of purchase requisitions that they have to place. So number 5. How about computer support? What determines the workload of computer support for each department? Yeah, about the number of computers. So a department that has just one computer is going to take a lot less time of computer support than a department where every person has 2 or 3 separate devices. How about conferences? Number of conference attendees. Employee travel.
Number 8.
Yep, how about the number of travel claims? Payroll accounting seems to be related to the number of employees.
3.
Well, that's number of employees trained.
Wait, no. I think that. Oh, yeah. I think payroll account would be 7.
7, yeah. And I think 3 would be, because it refers to number of employees trained, would be the driver for the training department. And I had that same issue when I first looked at that, Seth. I'm reading down the list. I said, oh, number of employees. And then I saw that last word tacked down there. So, and then what do we have left? 4, telecommunications, number of cell phones, minutes used. Okay. Okay, so if we are allocating our support department costs based on these kind of activity drivers, it does make sense to hold management responsible for those support department costs based on their usage of those support departments. So if we went back to this previous exercise, we look at this budget performance report for the supervisor of the chip fabrication department. And we see here maintenance. Well, that is a support department, and those costs are allocated way back to the beginning of class today. When we started this chapter, I said we only want to hold management responsible for costs that come under their direct control. So why are we including maintenance here? And we get the idea of why that might be the case when we consider exercise 2. Because maintenance is, even though it's provided by a support department, it still is part of running that chip fabrication department. So it's not that we don't look at any allocated costs, but we look at the ones that come under the direct control of the manager. So the manager is responsible for maintaining those machines and calling in the maintenance department to do preventive maintenance and to repair machines that might be, you know, in need of fixing. Let me go back to our PowerPoint. But any questions at this point? So we've covered cost centers and talked about why there might be some allocated costs in there, even though they are a separate department. Any questions before we move on to profit centers? So as you can see on the screen, a profit center, the manager of that profit center is now not only responsible for costs, but also for the revenues that are generated by that department. And so as we look at oh, I apologize. We're going to go back. We're going to do exercise 3 in just a moment, which actually comes before we get to profit centers. So that's my mistake. But I'll finish talking about this since we're here, then we'll go to exercise 3 and 4 at the same time. So profit centers are more looking at the entire income statement. We're going to be looking at revenues and expenses and the bottom line, the income or operating income generated by that profit center. What's not included here, and we'll bring that in when we get to investment centers, is the balance sheet part of the equation, the balance sheet part of our financial statements. Because the understanding within a profit center is that manager does not make decisions regarding the deployment of fixed assets, property, plant, and equipment. Capital investment decision-making is not up to this manager. And so the profit center manager is going to be evaluated based on an income statement that includes the controllable revenues and expenses that come under that manager's responsibility, but not anything related to the balance sheet. And so you can see some examples here. I can get that out of my way. That there are some support departments that may be allocating costs out to our profit centers. I'm having trouble getting it to change pages today. And I want to find an example here. Give me just a moment. Here we go. And so our tool for analysis for a profit center might look like what you see here. We've got 2 separate divisions. Each one of these would be considered a profit center, that they each have their own controllable revenues and expenses, including those support department allocations that we've just been talking about. And so you can see support department allocations from purchasing, payroll, and legal. And we're going to evaluate each one of these divisions based on this operating income. Again, no calculations relating to the balance sheet, to the use of the assets at the theme park or at the movie production division, because the understanding is if it's a profit center, the manager doesn't have control over how assets are invested. Okay, let's go back to our exercises. Barney Corporation, a manufacturer of electronics and communication systems, allocates computing and communication services department costs to profit centers. The following table lists the types of services and cost drivers for each service. The table also includes the budgeted cost and quantity for each service for August. So we have 4 different services that we're going to be allocating. We've already identified an appropriate cost driver for each one of those. Help desk, network center, electronic mail, and smartphone support. And then we're given some additional information here about Barney Corporation. It's going to help us determine how to allocate costs to this COM division or communication system division. There's just one division that receives services from this table of services. It's going to receive some of those costs, but not all of them, because there are other divisions within this company, within Barney Corporation. Okay, so we're just looking at one of those cost, one of the profit centers. So I'm going to use this little section of white here to do some calculations. As we're allocating these costs, we are going to use the direct method for allocating costs. What that means is we're allocating directly to the profit center. We are not allocating these support costs to other support departments. We are not allocating these costs to other production departments and then allocating them again. So we're not using the step down, sequential, or the reciprocal method. We are using the direct method, which, if you recall, is the easiest way of allocating these costs. It's the only way we can do it here because we're only working with one department, one profit center. So give me just a second here. Okay. So for each one of these CCS or Computing and Communication Services departments, for each one of these services that they provide to the profit centers, we're going to calculate a cost per service. And then I'm going to have to scroll down, and I'm going to hopefully be able to keep it over to the side a little bit. So for the help desk, I'm just going to abbreviate that HD because I need to be able to fit these in here and still be able to see them. For the help desk, their budgeted cost is $90,000 and they expect to have 3,600 service calls. And so the cost would be $25 per call. And so profit centers that use more help desk service are going to be allocated more of that cost. For the network center, the budgeted cost is $120,000 and they expect to have 1,500 devices. And so their cost is, this up a little bit, trying to just keep it off to the side so I can scroll down and still read. So the network center is going to allocate support department cost at $80 per device supported. Everyone okay with what we're doing so far? go ahead and do email and smartphone then. Okay, so we can now plug in our answers that I put over there on the side now that I can scroll down. So the help desk is going to be allocated at $25 per call. The network center is going to be allocated at $80 per device. Electronic mail, $30 per user account. And smartphone, $18 per phone. Okay. Everybody good? The COM department, which is the Communication Systems Division, the COM sector has 2,500 employees, of whom 20% are office employees. So let me start doing some calculations, and I'm going to put my notes here on the screen for us. So the COM division has 2,500 employees. Get this out of my way. 2,500 employees, and 20% of them are office employees. So 20% of the 2,500 employees, they have 500 office employees. That's what that first bullet point is telling us. All of the office employees have been issued a smartphone. 95% of them have a computer on the network. So 500 smartphones for the office employees. 95% of those 500 have a computer on the network. So 95% of 500 is 475 computers on the network. That's the second bullet point. 100% of the employees with a computer also have an email account. So if there are 475 computers on the network, there are 475 email accounts. The average number of help desk calls for August was 0.6 calls per individual with a computer. So if there are 475 computers and it's 0.6 calls per computer, that's 285 help desk calls in August. And then there are 400 additional devices on the network. Okay, does everyone agree with those statistics about the COM sector? Okay, so hopefully we now have what we need to allocate the support department costs to the COM sector for each one of those 4 support services. We start with the help desk charge, and we can see, oops. Okay, so we can see right here, we had 285 help desk calls in August. And help desk is allocated at $25 per call. $285. Sorry, 285 calls at $25 each would be an allocation of $7,125 for help desk services. And remember, the total budgeted cost for the help desk is $90,000, but the comm division is just one profit center within Barney Corporation. And so we're not accounting for all of those costs. We're only accounting for the part that was used by the comm sector in August. So that $90,000 is also probably an annual amount, but I'm not sure. Oh no, it actually says the table includes the budgeted cost for each service for August. So for the company as a whole, it's $90,000 and $7,125 of that will be allocated to the comm sector. How about the network center charge? The network center charge is $80 per device monitored. And so we have 500 smartphones. What are we counting as devices? Is the, are they, oh, on the network. Sorry, yeah, on the net. These are devices on the network because it's the network center. That makes sense. So we're talking about the computers on the network and then these additional devices on the network. So that's 475 computers and 400 additional devices, a total of 875 devices, and we're charging them, or we're allocating cost of $80 per device monitored. Whoops, for a total of $70,000, which I started punching into my calculator. So 475 computers on the network, 400 additional devices on the network for a total of 875 devices at $80 each. Email is allocated at $30 per user or email account, and we have 475 email accounts. 475 accounts at $30 each, total of $15,200 for email. And finally, the smartphone charge, and there are 500 smartphones for the office. 500 smartphones at $18 each is a total of $9,000. And so for each of these then, we allocate these support department costs to the comm sector, and then they would be included in our evaluation of the performance of that comm sector manager. The assumption is that the comm sector manager gets to decide whether every employee gets a smartphone, how many of the employees need a computer, how many of the employees need to have email on that computer. And so it is appropriate to include these support department costs in the analysis of that profit center when the manager has control over that. Now, if somebody else above that manager decides, you know what, 100% of the office employees should have a computer, it's really not appropriate, or if you want to use that word, fair, to hold that, to include that in the analysis for the manager when that decision would be taken out of his or her hands. Get our green check marks in there. I'm going to clear my screen. Any questions though before I do that? And we will keep going. Divisional income statements with support department allocations. And so this is what we're going to be doing. Looks very similar in format to what we just saw in the PowerPoint. So the top portion of this income statement, this is a profit center. We can tell it's a profit center, even though it doesn't say that, because it's an income statement for the division. It's going to include the controllable revenues and expenses. So I could probably, without even reading the rest of the problem, think about what's going to be included here. We start with our controllable revenues, and we subtract from that our cost of goods sold to get gross profit, and then we subtract our operating expenses that are controllable. And then we're going to have support department allocations. And again, looking at the drop-down list, I can guess what those are going to be from tech services and from the purchasing department. So we're going to allocate cost to each one of these divisions, and then we will have our, there it is, operating income or operating loss if it turns out to be the case, that they lost money within the division. So it looks very similar to the corporate form of the income statement, where we have our multi-step gross profit or gross margin in here. Just like we saw in the PowerPoint, we're then going to allocate from the support departments and then get our bottom line. But let's go back and continue reading what it says. I just wanted you to see the format of what we are going to be doing. So we have two divisions. Each division presumably has a manager. That manager has some authority over the revenues and expenses produced by that department. But because this is a profit center, not an investment center, we're looking only at the income statement portion of the analysis. We're not looking at anything that would be balance sheet related. The corporate expenses for the year ended December 31st are as follows: tech services, purchasing, and other corporate administrative expenses. The other corporate administrative expenses include officer salaries and other expenses required by the corporation. So if those are required by the corporation, we should not be looking at them in the context of the consumer and commercial divisions as we're analyzing their performance, because they can't control, they have no control, no say in those corporate level expenses. However, tech services and the purchasing department do provide direct support that is within the control of those two profit centers. And so you can see, and this makes sense, we're going to allocate tech services based on the number of computers and purchasing based on the number of purchase orders. So the consumer division has a lot more computers than the commercial division, but the commercial division places twice as many purchase orders. So it makes sense that the purchasing costs are going to weigh more heavily on the commercial division, while the computer costs are going to be borne more heavily by the consumer division. And as I already pointed out, these support department allocations are considered controllable by the division, so it is appropriate to include those in our performance analysis. So let's start with the information we have that is direct information. We have revenues and cost of goods sold and operating expenses for the consumer and commercial divisions. So this is not anything new. We're just going to be entering those data from the consumer and commercial divisions. Gross profit, you've known how to calculate that since chapter 4. Actually, it's chapter 5. Chapter 5 in this textbook. Still, it was a long time ago. You hear me call that more regularly gross margin. This book, for whatever reason, really likes that term gross profit. I don't really care for that when we're talking about the company as a whole like this. We normally use that term gross profit when we're talking about an individual product. And then we have our operating expenses given. And so the consumer division is a much smaller division. In terms of their revenues, it's less than half. In terms of their operating income before the support department allocations, it's only about, what, one-fifth of the total for the commercial division. But now we get to the allocation of the support department costs. And let's go back up here. And I'm again going to put my calculations over here on the side so that I can scroll down and still be able to read those. So from the tech services department, their costs are $1,170,000. And they're going to allocate their costs based on the number of computers. And there are 1,800 computers total across these two divisions. And so if we take that total cost of $1,170,000 and divide by 1,800 computers, we come up with an allocation rate of $650 per computer. And for purchasing, the purchasing department's total cost is $450,000, and they're going to allocate based on number of purchase orders, and they anticipate having 12,000 purchase orders. And so that works out to be $37.50 per purchase order. And if you're not familiar with that, PO is the normal abbreviation, the commonly used abbreviation for a purchase order, a PO. Okay, everybody okay with where those came from? You'll notice we're not including anything about these other corporate administrative expenses because we're looking at a profit center, and the administrative expenses are not considered controllable by that division, so we're not going to be including them in our analysis. It's not appropriate to evaluate the performance of the division, including those costs that are not controllable. Okay, so now we're going to do the allocation to the consumer division based on their actual usage of these services. Tech services supports 1,100 computers for the consumer division, 1,100 computers at the rate we already calculated, $650 per computer. We're going to allocate $715,000 of tech services to the consumer division. And the other 700 computers are within the commercial division. So 700 computers at $650 each is a total of $455,000. And then we do the same thing for the purchasing department. So go ahead and do that based on the 4,000 purchase orders in the consumer division and 8,000 within the commercial division. And the last step then of this report is to subtract the total support department allocations from the operating income before support department allocations. And so, what do we learn from this? It's important how we choose our cost driver or allocation basis. If we looked at the consumer division compared to the commercial division and said, you know what, we should just allocate these based on revenues. The commercial division is more than twice the size of the consumer division. So I don't know, let's give them 2/3 of the cost and the consumer department 1/3 of the cost. That wouldn't be an equitable split of those costs because the consumer division has a lot more computers, even though they're a much smaller division. Yes, the purchasing department is used more heavily by the commercial division, but overall, the purchasing division is a lot cheaper to run than the tech services department. And so one advantage of doing this type of support department allocation and then using it in our evaluation of the performance of these profit centers is it, if nothing else, it might make the manager of the consumer division look at this and say, whoa, do we really need to have all those computers? Maybe there's some efficiencies to be gained by cutting back on our usage of those support services. When we're in control of how much we use, when we empower the managers to make decisions such as, yeah, I think we need 1,100 computers. If we did not hold that manager then responsible for that cost allocation, it's easy, to be like, no, I'm only responsible for this. The tech services department is responsible for the cost of the tech service department. And so it leads to potentially some inefficiencies when we aren't holding the managers responsible for the costs that they do actually control. Again, appropriate here that we do not include those overhead administrative costs because we're told these divisions don't have any say in that, don't have any authority or decision-making ability related to that. Check marks in there. Any questions about using this type of an evaluation for a profit center? Let's keep going then. Here are my lines. Okay. Exercise 5. Corrections to support department allocations for a service company. So as has been the case in the last few chapters, what we are covering here is also relevant for service companies. So we do not always have to be manufacturing or even selling a product at all. We can still use these same concepts of responsibility accounting, cost centers, profit centers, investment centers within a service organization as well. Rocky Mountain Airlines Incorporated has 2 divisions organized as profit centers, the passenger division and the cargo division. The following divisional income statements were prepared. And so what we see here looks very similar to what we did in the last exercise. We have our direct revenues and operating expenses. Then we have our support department allocations from the support departments that are seen to be under the control of those individual managers. And so what do we notice here? The passenger and the cargo division have exactly the same revenues. And that may or may not be connected, we'll keep reading, but it may be connected to what we see here, that each of the 2 divisions was given 50% of the cost of each one of those support departments. Okay, yeah, and it tells us right here. The support department allocation rates were based on revenues, which may not have any connection to the actual usage of training, flight scheduling, and reservation systems. Because the revenues of the 2 divisions were the same, the support department allocations to each division were also the same. And so the cargo division really suffered from that, at least on the face of it, because even though their revenues were the same, their operating expenses were higher. And when they were hit with the same total support department allocations, it flipped them to an operating loss compared to the passenger division's operating income. Now, I'm not suggesting, because we haven't gotten there yet, I'm not suggesting that that's wrong, that the cargo division is showing an operating loss. And so the manager of the cargo division is going to be evaluated negatively based on that. Hey, your division's losing money. What's going on here? But what I am suggesting is revenues may not be the most accurate way of splitting or sharing those support department costs. And as we scroll down, what do we see here? Well, the passenger division has 3 times as many people as the cargo division who are getting trained. So it makes sense then that the passenger division should get more of the cost of training because they're training 3 times as many people. The cargo division actually had more flights, 50% more flights than the passenger division. So probably the flight scheduling should go more heavily to the cargo division because they had more flights. And finally, the number of reservations requested. Well, there are no reservations on a cargo flight. And so splitting the cost of reservations really doesn't make any sense because the cargo division doesn't even use the reservation system. And so all of those costs should be allocated or assigned to the passenger division. And so what we are going to do down here at the bottom, and then we'll come back and answer the questions in letter A. What we're going to do down here at the bottom is reconfigure the support department allocations based on these concepts that we have here, these cost drivers. Rather than using just revenues, we're going to use a separate cost allocation or driver for each one of the 3 support departments. The first thing we need to do, this support department allocation does not affect the revenues. You'll notice we don't have the step for cost of goods sold and gross margin because these are service companies. Okay? These are service divisions. They don't have a product they're selling, and so there is no cost of goods sold. For the companies that you chose for the project, as a reminder, if you chose a service company, and I can't tell you off the top of my head who may have done that, but if you chose a service company for your project, there are going to be some pieces of your project that you also are not going to be able to answer in the same way. So for example, there are some required calculations related to inventory turnover, days inventory on hand. If you chose a service company, you're simply not going to be able to calculate those. Please don't just skip over them. Tell me, not applicable because this is a service company. They don't have inventory. Tell me that you know why you can't calculate those. But go ahead and complete the first 3 lines here, just pulling in those data from the original report here at the top. It doesn't tell us whether we need to use negatives, so I'll leave that to your discretion. And then we have our 3 support departments: training, scheduling, and reservations. Whoops, not revenues, reservations. And rather than just splitting them 50-50 based on revenues, we're going to reallocate based on these data here. And so once again, I'm going to do the calculations over here on the side so we can then scroll down and retain those. So for training, what do we have for total cost for training? It's $180,000 plus $180,000, a total of $360,000 for training. I can see that right here, total of $360,000 for training. And there were 800 personnel trained. And so that's a total of $450 per person trained. $360,000 for the training department divided by 800 personnel trained, $450 per person. For scheduling, $275,000 times 2, or $550,000 total for scheduling. And we scheduled 2,500 flights. So that's a total of $220 per flight scheduled. And reservations, we don't even really need to do the calculation for reservations. We can see that the cargo division had no reservations. And so the full cost of the reservation system, 375,000 times 2, the full cost should be borne by the passenger division. I'm just going to go ahead and enter that in here. Again, it doesn't tell us whether to use negatives or not. I'm going to be consistent and just use negatives because they did in the original report. But you can choose to do that how you'd like. Tells us we can leave it blank or enter 0. So I'm just going to enter a 0 there for reservations for the cargo division. And then we'll look at the training. So for the passenger division, they had 600 people trained, and we calculated the cost of training at $450 per person. And the cargo division had only 200 people trained at $450 per person. For flight scheduling, the passenger division had 1,000 flights and the cargo division had 1,500. So at $220 per flight, those would be our allocations. Add those up, total support department allocations for each division. And what you'll notice is that there's been a total change in the end results. The passenger division, their operating income, once they assume full responsibility for the reservations in particular, reservations is the most expensive of the 3 support departments that we're looking at. And so when we flipped half of that cost to the cargo division, really unfairly because the cargo division didn't even use the reservation system, that made the cargo division show that negative or operating loss. And now, if we look at this in total, the operating income for the 2 divisions in total, I just want you to see this. Use my calculator. The operating income for the 2 divisions in total is $540,000. If we scroll up here to the top and look at the original values, it's still $540,000 in total. We didn't manufacture any more income. We didn't lose any income. What we have done is shift the burden of those support department costs. It's the same total cost, but we have shifted it appropriately based on the actual usage of those support departments, not based on that arbitrary revenues, which doesn't have any relation to the usage of these 3 support departments, which is very different across the 2 divisions. So let's go back to letter A and see what we're looking for here. Does the operating income or loss for the 2 divisions accurately measure performance? I think we can clearly see now that the operating income does not accurately measure performance because the support department charges are based on revenues. Revenues are not associated with the profit center manager's use of the support department services. Any questions? Green check marks in there. I'd like to do that.
So who would kind of be in charge of making sure they're accurately allocated? Would it be whoever's in charge of the passenger cargo division, or whoever's in charge of each of the support?
It would be up to the accounting department.
Okay.
And yeah, you're right. The support department certainly should be consulted to say, okay, what is the driver of your, of usage of your service? How do we, what's the appropriate driver? In that exercise we went through, exercise 2, talking about appropriate drivers. That's a conversation that probably only needs to be had one time, right? So we're not every year going to look at this and say, gee, what should we use for our cost driver this year, right? It's still going to be, it's going to be fairly standard. Now, over time, things could change. So 25 years ago, I worked at a, 27 years ago now, I worked at a company where I had a computer, but I didn't have email. I had intercompany email, but no email like we think of it today. And nobody did. It was a large company, large employer, hundreds of employees, and there were like 3 people that had external email as part of the business. So you do have to look at those kind of usage changes. If we were allocating tech support for that company and not taking into account email or cell phones or whatever, you do have to watch for those change in usage patterns and new forms of use, if you want to think of it like that. But yeah, it would not be up to the passenger division to say, I think that training should be allocated based on number of hours of training or whatever. That being said, if the manager of either one of those divisions believes that the allocation is unfair, doesn't really reflect actual usage, it would be up to the manager to speak up, because if we look at this top, the originals that we have here, if I'm the cargo division manager, I'm looking at this saying, $375,000 for reservations. We don't even use reservations. Then that person needs to speak up and register the concern, because as we've been saying, this is a profit center report. We are evaluating the division manager based on really this number. And so it's up to that manager to say, something's not right here, because we don't use the reservation system. And we trained a lot fewer people. And okay, I want to be fair here. We did schedule more flights, and so we probably should be getting more of that cost. That's a perfectly appropriate position to take, that, wait a minute, if you're going to look at the support departments at all, you have to be equitable about it. But ultimately, it's not up to those managers to decide how it's divided.
Okay.
They might be part of the conversation. And as I said, it's not like that conversation is happening every year. How do we want to do it this year? It's going to be relatively stable.
Like doing a check-in every year.
Mhm.
Like, I mean, the easiest example I can think of for something that changes over time would be like a IT department,
Mhm.
where when it starts, all right, we're going to do it by phone calls for services needed.
Yeah.
And then check in and be like, you know what? Well, this year we actually got more emails than phone calls, or last year we did.
Yeah.
So
Yeah,
it's
good
trending that way. And then,
Mhm.
okay.
Yeah, because that's a really good example, because we do that here at JCC. We have a help desk. They have a phone. I've never called it. If I need help desk support, I send them an email. But so if they were still, but I mean, years ago, I'm sure there are still people who call them. I'm sure there are people who call them. I'm just not one of them. So yeah, if we were still looking at allocating support department help desk calls or help desk service based on phone calls, we'd be missing a whole piece of the puzzle.
But
Yeah,
it would be
good
a whole
idea.
huge conversation, just kind of a check-in.
Yeah, and that would probably happen during the budgeting process, because all of these are our actual results, I think, here. But we'd be comparing these two budgets, and each year we're setting up, okay, what do we think is going to happen next year? And so, yeah, I can see it being part of that budget conversation. Okay, we've always done training based on number of people trained. Does that still make sense? Because maybe the cargo division training is a multi-day training, and the passenger division one and done, one day you're done. So maybe instead of number of people trained, where is that here? Number of personnel trained, it should be based on number of training hours. So, you absolutely should be looking for those changes in usage pattern, but certainly not every month, or, it's not going to be very regular, but I can see it being part of the budget process to say, wait, what's changed here? All right, we are done for today. We are halfway through this chapter. Any questions before I stop recording for today? Any other comments? All right, well, thank you for being here, and I hope to see you on Thursday when it's going to be much, much warmer.